October tends to make a lot of folks, especially investors in the United States and worldwide, feel a bit uneasy. You see, many people think October brings along a drop in stock prices and some pretty scary investment results. They've even given it a spooky name, the October effect. Now, this October effect is basically a widely accepted idea that stock values tend to go down during October. If you look back in history, you'll find that many major stock market downturns happened right in this month. So, it's no wonder that some investors get a little jittery when October comes around. But let's not just dwell on the past. Is there any real reason why October gets this reputation as the scariest month in the financial world? That's what we're here to discuss in this video. We'll dig into the numbers and see what they have to say. So join us as we take a closer look at the October effect and see if it's all just hype or if there's some substance to it. When we look at the S&P's performance over the past 92 years, it becomes clear that October isn't as dreadful for the stock market as it's made out to be. In fact, if we crunch the numbers, we find that the S&P 500 has actually seen more gains than losses in October during this lengthy period. So, if October isn't the worst month for investors, what is, you ask? Well, it turns out that September, the month right before October, is statistically the toughest time for investors. In September, investors tend to see about a 1% loss on average. History backs this up, showing that September can be quite a challenging month for stocks. Going back to 1950, it's been the roughest month for the S&P 500, with an average decline of 0.5%. Now, you might be wondering why September gets this gloomy reputation. Let's dive into that a bit and see why it's the worst performing month for investors. There are three main reasons why investors should be cautious about September, according to experts. First, there's something called profit taking. Historically, the stock market tends to take a dip in September because of changes in how investors behave during different seasons. As summer wraps up, many investors decide to rework their portfolios to lock in their gains. The second factor is tax loss harvesting. This is a strategy where some investment assets are deliberately sold at a loss. It might sound counterintuitive, but it's done to lower the amount of taxes owed at the end of the year. Investors use this technique to balance out the capital gains they make by selling assets at a profit. Lastly, you have investor vacations. During the summer months, lots of investors are on vacation, and trading activity slows down. When they return, they often start selling off the positions they had planned to sell. This surge in selling as summer winds down can create extra selling pressure and lead to an overall market decline. So that's another reason why September can be a tricky month for the stock market. Investors tend to fear October because it's the month where some of the most severe stock market declines in history have taken place. The October effect has become deeply rooted in the minds of investors due to these significant historical events. One of these events was Black Tuesday, which occurred on October 29, 1929. It was a major turning point in history known as the Great Crash, and it marked the start of the Great Depression, a devastating economic period. Another significant event happened on Black Monday, which took place on October 19, 1987. On that day, the Dow Jones Industrial Average plummeted by over 20%, marking its most significant one-day percentage loss in history. This event is etched in investors' memories as a severe market crash. In the more recent past, October 2008 was a brutal month during the global financial crisis. The Dow Jones dropped approximately 14%, reflecting the economic turmoil of the times. These major historical events, all occurring in the month of October, are the foundation of the October effect myth. It's no wonder that these events have left a lasting impression on investors, making them particularly cautious when October rolls around. Back on October 29, 1929, something pretty bad happened on Wall Street. Investors were trading a staggering 16 million shares in a single day on the New York Stock Exchange. This led to losses in the billions, and it hit thousands of investors hard. The aftermath of this, not just in America but also in the industrialized world, was the Great Depression from 1929 to 1939. It was the worst and longest economic downturn ever experienced in the Western industrialized world up to that point. So, what caused this big stock market crash in 1929? Well, during the 1920s, the US stock market was growing super fast. It reached its peak in August 1929 after a wild period of people speculating about stocks during the Roaring '20s. By then, things like production were slowing down and unemployment was going up. This meant stocks were way more expensive than they should have been. There were other reasons for the crash too, like low wages, loads of debt, troubles in the agriculture sector, and too many big bank loans that couldn't be paid back. After that gloomy day in 1929, stock prices couldn't really go anywhere but up, so there was some recovery in the weeks that followed. But overall, prices just kept on dropping as the United States got deeper into the Great Depression inflation. By 1932, stocks were worth only about 20% of what they were in the summer of 1929. And let's not forget about another important day, Black Monday, which happened on October 19, 1987. On that day, the Dow Jones Industrial Average took a massive dive of over 20%, making it the biggest one-day drop in history. Black Monday, a day etched in the memory of investors, witnessed a global stock market crash. However, this event didn't unfold all at once. On Black Monday, the US stock market saw its most substantial one-day percentage drop in history, with the Dow Jones Industrial Average, DJIA, plummeting by slightly more than 22%, and the S&P 500 index experiencing a similar decline of 20.4%. To put this into perspective, the worst one-day drop in the DJIA during the stock market crash of 1929 was just over 12%, barely more than half of the decline that occurred on Black Monday in 1987. So, how did this dramatic event happen? There were warning signs for investors in the days leading up to Black Monday. On October 14, the Dow experienced a significant decline of nearly 4%, followed by another 2.5% drop the next day. On October 16, the Friday before Black Monday, the London stock market suffered a devastating 5% loss, coinciding ominously with the Great Storm of 1987, an unprecedented severe weather phenomenon producing hurricane-force winds in the English Channel and resulting in numerous fatalities. The crash began in Hong Kong on Monday morning, extending throughout Asia during the Asian trading session. As other markets felt the aftershocks, the market turmoil spread to Europe when the London market session opened. By the time the US stock market opened, stocks were in a state of virtual freefall. By the end of the day, the DJIA had dropped by more than 500 points, and the S&P 500 by more than 55 points. Black Monday left a lasting scar on investors and further solidified the notion that October is a challenging month for the stock market. Now, you might be wondering, when are the best months to invest? Investors often ponder the best time to enter the market, and specific months carry distinct trends. Surprisingly, October, despite its historical setbacks in 1929 and 1987, tends to yield positive returns. There's the January effect, which recommends buying in December, and the Santa Claus rally that favors November for buying. On the flip side, some suggest the old adage, sell in May. August and September are commonly considered less favorable months. Speaking of average returns, January, April, and December are the months to highlight. January, it's a pivotal month for the market as numerous US companies unveil new products and innovations to entice investors. April, in the US, April 15th, known as Tax Day, prompts many to think about investing due to tax reforms, leading to an influx of investors. December, with religious holidays and heightened spending, publicly traded companies experience increased sales and revenue growth. Investors often diversify their portfolios during this month. And that sums up this video. We've unraveled the mysteries of investing in different months and the historical trends that guide us. Before we wrap up, remember to hit that like button if you found this video useful. Drop your thoughts in the comments below. And don't forget to subscribe for more insightful content. We're here to help you make informed decisions in your financial journey. Until next time, happy investing, and see you in the next video.